Folks, you are not going to believe what the volatility index did this week. She sat there almost the entire time refusing to move, while the entire world tried to hand her every reason to spike. Middle East tensions boiling over sanctions, flying fresh naval posturing in the Gulf, and even whispers of a major Fed leadership change. Yet she parked herself right around 18, barely blinking. The S&P 500, on the other hand, decided it was going higher anyway, pinned near 7,400 at the open and closing the week right around 7,500. Now ask yourself, when was the last time you saw fear get this polite? This episode is brought to you by Iron Condor Command, the definitive guide that has helped thousands of traders master defined risk strategies with confidence. Let me take you back to the beginning of the week. Monday morning, the market woke up to a world that had already been spinning for days on geopolitical fault lines. The weekend flashes from Miss Vicky had laid it out clearly. Escalating United States-Iran tensions with fresh sanctions targeting military procurement networks, naval movements in the Strait of Hormuz raising oil supply fears, Russia reportedly considering unjammable drone technology for Iran, and on top of all that, a potential Powell to Warsh transition at the Federal Reserve that could tilt policy tighter and more data dependent. You and I know what that kind of cocktail usually does. It should have sent the volatility index screaming higher right out of the gate. Instead, she opened the week at 17 and 2/10, calm, almost dismissive, as if she had seen this movie before and knew how it ended. The S&P 500 sat right at 7398.93, perfectly flat from the previous close. No panic selling, no euphoric buying, just this strange equilibrium that felt too orderly for the headlines. Smart money, I believe, had already priced in the diplomatic runway. Those possible talks resuming in Islamabad, with Qatar playing mediator through J.D. Vance's closed-door meetings. The tape was saying the risk was real but contained. Tuesday brought more of the same tension, but with a different flavor. Bitcoin had pushed above 80,000 over the weekend, and it held steady near there, showing remarkable resilience for an asset that usually catches a cold when geopolitics sneezes. China delivered a strong April export beat ahead of the Trump-Xi summit. That 14.1% jump in exports signaled real policy resilience despite elevated tariffs. Yet the Strait of Hormuz saw fresh clashes, and Trump threatened to resume Project Freedom. Oil responded. West Texas Intermediate crude climbed from $98.07 on Monday all the way to $102.18 on Tuesday. You could feel the energy premium building. The volatility index, however, barely budged. She ticked up to 18 and 4/10, but that was it. No real expansion, no fear explosion. This is where it gets interesting. The dollar started showing its muscle. The DXY moved from 97.94 to 98.29. Modest but meaningful strength. That dollar bid usually weighs on risk assets, and especially on gold. Sure enough, gold, which had been grinding higher in recent weeks, began to give back ground, slipping from $4,718.70 on Monday down to $4,677.60 on Tuesday. Now listen, here's the first unexpected connection that most people missed. While equities stayed pinned and the volatility index refused to panic, Bitcoin held firm above 80,000. That crypto resilience told us something the equity tape was not yet shouting. Institutional money was viewing the Middle East noise as headline risk, not structural risk. They were not fleeing to cash. They were not dumping growth assets. They were sitting tight. That selective risk appetite combined with India's structural resilience, despite some foreign outflows, painted a picture of contained chaos. India's defense infrastructure and energy sectors looked like long-term compounders, even as their equity market took a temporary hit from the risk-off flows. The conservative lens here is important. Sanctions have always been a preferred economic pressure tool because they avoid the unsustainable long-term costs of direct conflict. The tape showed that reality. Oil firmed but did not explode. The volatility index lifted modestly, but stayed inside that 15 to 20 regime that has defined so much of this year. Our VixShield risk scaling algorithm took one look at that setup and kept us squarely in conservative iron condor mode. No aggressive tier, no oversizing. The expected daily range stayed well below the 0.94% gate that would have triggered any temporal theta martingale adjustment. Each day remained independent. Monday's trade expired Tuesday. Tuesday's trade expired Wednesday. Clean slate every single time. By the end of Tuesday, the central tension of the week was crystal clear. Geopolitical heat was rising. Diplomatic channels were still open but fragile. The Federal Reserve succession speculation was growing louder, yet capital flows remained orderly. The S&P 500 refused to break lower. The volatility index refused to break higher. She was whispering when the headlines were screaming. That disconnect, my friends, is what makes this business so fascinating. Most analysts would have called for panic. The tape simply would not cooperate, and that sets up everything that came next. Because when the volatility index gets this polite in the face of real tension, you start wondering what she knows that the rest of us do not. Wednesday and Thursday. This is where the week took its turn, and honestly, it was one of the more revealing stretches we have seen in months. The expected escalation did not quite materialize the way the headlines suggested it would. Instead, something more subtle happened. The market began to digest the noise and price in the diplomatic track with even more conviction. Wednesday opened with the S&P 500 still hovering right around 7,400, the volatility index at 17 and 9/10. She had given back a little of Tuesday's modest gain, almost as if she was second-guessing her own earlier caution. Oil pulled back slightly to $101.02. That gave some breathing room, but the dollar kept climbing. The DXY reached 98.48. Gold responded in kind, falling further to $4,697.70. The inverse relationship was working exactly as you would expect in a conservative framework. Stronger dollar, lower gold, contained volatility. Here is the second unexpected connection that the mainstream financial media completely missed. While everyone was watching the Strait of Hormuz and the potential for oil supply disruption, Bitcoin started to drift lower. It closed Wednesday at $79,277, down from the weekend highs above 80,000. That move happened even as the S&P 500 held steady. Crypto was signaling something the equity market had not yet fully absorbed. Perhaps the cumulative weight of geopolitical fatigue was starting to matter. Or maybe smart money was rotating out of high beta risk assets into the safety of the dollar, which continued its climb. The Federal Reserve succession story gained even more traction midweek. The potential shift from Powell to Warsh was being viewed through a conservative lens, as likely implying a tighter or more data-dependent path. That should have lifted volatility. It should have weighed on multiples. Instead, the volatility index stayed disciplined. She would not break out of the high teens. That tells you the market had already baked in the tighter policy bias. What they are telling you on television is panic about leadership change. What the tape actually showed was preparation. Thursday brought another twist. The S&P 500 pushed higher, closing at 74.44. The volatility index gave up more ground, settling at 17 and 5/10. She was actually declining while equities advanced. That is not normal behavior when the Middle East is this unstable. Yet it happened. Oil firmed again to $101.17. The dollar strengthened further to 98.88. Gold continued its slide to $4,678.10. Bitcoin, however, found its footing closing at $81,051. A nice rebound. This is where the third invisible thread revealed itself. The yen carry trade dynamics that everyone had forgotten about suddenly mattered again. As the dollar strengthened and the volatility index stayed low, the incentive to borrow yen and buy higher yielding assets reasserted itself. That flow helped support equities, even as gold and crypto told slightly different stories. The volatility index looked at all of it and basically shrugged. She settled the week in that same high teens range she had occupied for months. Contango remained intact. The term structure was telling us that longer-dated volatility was priced higher than near-term volatility, the calm, normal state of markets. Our conservative iron Condor positioning benefited directly from this setup. Every day we placed or held according to the RSI signals. This week the algorithm called for hold on all 5 trading days. That is not a failure. That is discipline. When the expected daily range stays suppressed and the volatility index refuses to expand, the conservative tier is exactly where you want to be. No need to force premium collection when the math does not justify it. The adaptive layered VIX hedge remained on standby. Ready but not yet needed. That patience protected capital while the geopolitical drama played out. You could feel the shift in real time if you were sitting at your desk Thursday afternoon. The snap higher in the S&P 500 came with almost no expansion in fear. That is when you realized the week had changed. What started as potential crisis had morphed into contained volatility expansion. The volatility index had been the character with the most interesting personality all week, sometimes laughing at the headlines, sometimes whispering caution, always refusing to overreact. That character development told the real story. Friday brought the resolution, and it was as orderly as the rest of the week had been chaotic underneath the surface. The S&P 500 closed the week at 7,584, up more than 100 points from where it started. The volatility index settled at 17.5, essentially unchanged on the week, but with that slight uptick from the Sunday open. She had done her job. She had absorbed all the tension without breaking. Crude oil made its move on Friday, closing at $105.42. That was the highest print of the week. The energy market finally reflecting the cumulative supply concerns from the Gulf clashes and sanctions. The DXY pushed to 99.27, its strongest close in the period. That dollar strength put pressure on emerging market currencies and weighed on gold, which fell sharply to $4,555.80. The safe haven metal gave back ground as real rates firmed, and the dollar bid strengthened. Bitcoin closed at $79,066. Ethereum at $2,223. Crypto gave back some of its earlier resilience, but still held above key psychological levels. The week's tension resolved in favor of patience. The diplomatic track in the Middle East still had runway. Those potential talks in Islamabad had not been canceled. The Fed's succession speculation had been absorbed without derailing risk appetite. China's export strength had shown that tariff pressures were not yet derailing global trade flows. India's long-term growth narrative remained intact despite the temporary equity sell-off. All of these threads wove together into a single coherent picture. Markets were pricing risk premium in advance rather than reacting to headlines. That is the hallmark of a mature cycle. For VixShield subscribers, this resolution felt particularly satisfying. We placed no new trades this week. 5 straight hold signals. That pattern reveals something important. When the volatility index stays this disciplined and the expected daily range remains suppressed, the smartest move is often to do nothing. Our conservative positioning called for exactly that, range-bound action with modest upside drift. And that is precisely what we got. 3 of the 4 trades we had on from the previous week expired worthless for full credit. One hit a defined loss on the short put. But because each trade is independent, there was no carryover drama, no rolling, no hoping for mean reversion, just clean, defined risk outcomes. The discipline takeaway this week is crystal clear. Strict adherence to VIX risk scaling and those expected daily range gates protects theta collection while preventing oversizing. The adaptive layered VIX hedge layers remain ready for any breach above 20 or any expansion in the expected daily range in a contango adjacent low volatility regime that patience is your edge. Most traders would have forced trades this week chasing premium that was not really there. We did not. That is the difference between gambling and investing, between promotion and stewardship. The volatility index ended the week almost exactly where she started it, but the journey she took us on was anything but flat. She tested our conviction, she whispered when others were shouting, and in the end she validated the conservative approach. The S&P 500 grinding higher while she stayed calm created perfect conditions for defined risk strategies that do not care about the headline, only the math. Now let us pull back and look at the bigger picture, because this week was not really about any single asset. It was about how all of them spoke to each other in ways that revealed deeper truths about capital flows and risk appetite. Gold, for instance, told a fascinating story. It started the week strong, but ended down over 3%. That decline happened as the dollar strengthened more than 1%. The inverse correlation worked perfectly. But there is more to it. Gold also reflects real interest rates and geopolitical risk. The 10-year yield climbed from 4.41% to 4.59%. That rise in yields combined with the stronger dollar created a double headwind for the precious metal, yet it never collapsed. It gave ground grudgingly. That tells you the safe haven bid was still present, just not strong enough to overcome the policy signals. The dollar itself was the quiet hero of the week, climbing steadily from 97.94 all the way to 99.27. That strength supported the narrative of tighter policy under a potential Warsh Fed chair. It weighed on emerging markets. It pressured gold. It even seemed to cap crypto upside. Yet equities ignored it and pushed higher. That divergence is what makes this week so instructive. The S&P 500 at 7,500 tells you risk appetite remains intact. The DXY at 99 tells you caution is priced in. Both can be true at the same time. Crypto provided its own set of signals. Bitcoin opened the week above $81,728. It closed near 79,000, a 3% decline. Ethereum fell from $2,339 to $2,223. That underperformance relative to equities suggests institutional flows were selective. The AI leadership in the S&P 500 that powered the gains this week apparently did not need crypto confirmation. Yet Bitcoin never broke key support. It held above 78,000, even as oil spiked and gold fell. That resilience in the face of dollar strength and geopolitical tension deserves respect. It suggests that certain pockets of risk capital continue to view dips as buying opportunities. The bond market whispered on Wednesday what equities finally heard on Thursday. The 10-year yield, grinding higher in small increments, signaled that tighter policy expectations were taking root. That should have pressured multiples. Instead, the S&P 500 climbed. The invisible thread here connects back to the volatility index. Because she refused to expand, the cost of hedging stayed low. That allowed bulls to stay engaged. Lower hedging costs, plus contained energy volatility, plus selective crypto resilience, all combined to support the equity advance. Here is what the mainstream missed. The headlines screamed about Iran sanctions and potential oil shocks. The tape showed oil firming, but equities rising anyway. The pundits talked about Fed uncertainty. The volatility index showed the uncertainty was already priced. That gap between narrative and reality is where the real money is made. Not by predicting the next headline, but by reading how capital actually responds to the ones we already have. The term structure in contango by 2.93 points simply reinforced the message. Longer dated volatility remains more expensive than near term. Markets expect the current calm to persist. That setup favors the patient, defined risk trader who collects theta without needing direction. It punishes the over-leveraged speculator chasing momentum. So what does all of this mean for the scorecard? This week we placed 0 trades and held on all 5 days. That pattern reveals a market that was offering very little edge for new premium collection. The algorithm saw the suppressed expected daily range and the stable volatility regime and correctly told us to stand aside. That is not inaction. That is discipline. Last week we had 4 trades with 3 expiring worthless for full credit and 1 hitting a defined loss. This week the hold signals protected us from forcing trades into a low volatility environment where the credits were simply not attractive enough. The conservative tier performed exactly as designed. No aggressive overreach. No violation of the risk scaling rules. The adaptive layered VIX hedge stayed in reserve, ready for when the volatility index finally decides to wake up. That patience preserved capital and kept us positioned for the next opportunity. In a world of constant noise, that discipline is becoming rarer and more valuable. Most traders, I suspect, chased the geopolitical headlines this week. They probably widened their strikes or added size, trying to capture fear premium that never really materialized. We did not. We listened to the volatility index. We respected her mood. We let the math dictate the action. And because of that, our results reflected the reality of the week rather than the hype. 3 wins from last week's placements carried forward in spirit, even though each trade is independent. The one defined loss reminded us that even in calm regimes, the market can still tag a short put. That is why we use defined risk only. No unlimited downside. No hope trades. The bigger lesson is one I've been hammering for years. In low volatility regimes, strict adherence to your process separates the stewards from the promoters. The stewards stand aside when the edge disappears. The promoters force the issue and pay the price. This week, the tape rewarded the stewards. It will do so again. Tomorrow in our Sunday forecast, I will walk you through exactly what I am watching Monday morning. The economic calendar picks up with fresh inflation data that could test the Federal Reserve succession narrative. The volatility setup remains in that high teens range, but the term structure is telling us something important about the weeks ahead. I will show you how the Iron Condor positioning should adapt if we see any expansion in the expected daily range, and where the adaptive layered VIX hedge might finally get called into action. You will not want to miss the details, and be sure to listen for any breaking news from Miss Vicky. If you found this summary valuable, consider upgrading to Pro or higher for the full twice daily VixShield market summaries, proprietary signals, and private RSS feed. Visit www.vixshield.com to learn more. These signals and insights are for educational purposes only and are not financial advice. Trading involves substantial risk of loss. You can lose more than your initial investment. No live trade execution, signals only. Past performance is not indicative of future results. And now you know what the tape was really saying this week.